We're going to I have it queued up. You have it queued up. Yeah, we're going to find hidden price floors and price ceilings to pinpoint profit, and part of a spin on this. One of our members, Vince, wanted to find out. We had some really good trades this week on the Aussie dollar, the pound yen, pound dollar, and though we do a lot of scalping. I'm known as a short-term day trade expert and one of the foremost authorities of short-term discretionary high-frequency trading. However, when you get into a market where things are kind of chopping around, you want to be able to find better opportunities on the higher time frames. Okay, a lot of times you can sell a man and go away. Yeah, but a lot of times, you may not be able to do that. I mean, so what do you do? Okay, you get chopped around the lower time frame charts, right? And if you're watching this and it's the fall, or you're watching this in the future, hi future guys, and it's the fall, you know what I'm talking about. That the volume dries up, and when the volume dries up, prices start moving up and down and chopping around. There's not enough people in the party to make the party move. Have you ever been to a party, guys, and and you get there early and there's like 3 people there, or get to a club, or any type of social gathering, there's like 2 or 3 people there. It's kind of hard to get the party started, right? There's not a real festive environment. It's kind of awkward. You kind of don't make eye contact. You might hang around at the bar, look at your drink or something, or look at your watch. But I tell you what, you get a big group of people in late at night at a party, a New Year's party or something like that, and it gets it's again on. Hey, people are dancing, people are talking, there's a lot of chatter, there's a lot of buzz, and there's a party atmosphere. Well, I always liken the Forex trading to a party. And when you got a lot of people in the party, then you're going to have a lot of opportunity and a lot of volatility. That's what that is. It's the crowd. It's the crowd that's trading. Trading patterns is part of people. People make patterns. People are pattern people. Okay. So, however, when you get into this July, June, August, September, even up to like September, August, September, the party is not there because a lot of the big traders are in the Hamptons, New York. They go to the Hamptons and go on vacation, or they go in the French Riviera, or they're going to a lot just on holiday for a long period of time. So where does that leave us? Okay. So what we have to do is to move out to where the party is. And there is a party going on. It's just a party that is on a higher time frame. And it's like, okay, well, maybe the kids are back in school and there's no parties for the young people, but maybe you got to go to a senior party, okay? And, getting up there in age, it's like, hey, you know what? Hey, the 60-year-olds can kind of party too, right? So I always look at the higher time frames as older, slower, mellower, but they're still out there, and there's still lots of them. So what you got to do is move out to the higher time frame where that party is. I call it maybe in the senior world, out there. I know there's some 80-year-old scalpers too, so don't take any offense. I'm just using this whole party age analogy in order to make my point. Okay, so I'm not bashing old people, not bashing young people, but you guys understand. If you understand what I'm saying, just type of Y in the chat box, right? Okay, so we're gonna move to the party where the people are, and so that means going out to a higher time frame. It means moving from our 5-minute and minute charts, moving out to our dailies, our weeklies, and even our monthlies. Okay, because you're going to find a lot of the larger players that are like putting on long-term positions. Even a lot of people who are going away. And that was my idea with the Aussie CAD trade. It just I got out way too soon. was to like, you know what? It's kind of chopping around. I'm not doing too well during this summer chop season, so I was gonna throw the Aussie cat on, leave it, forget about it, and walk away. The tendency is, and I am the quintessential scalper, is, gee willikers, I'm up like 90 pips. Let me go ahead and pull it off. Well, gee, I get out in the 93s, and then it's all the way up to over parity right now. The Aussie cat is, which it went exactly to my target. And Vincent asked why or what, how can we find these larger price targets? In fact, I put one up there for Aussie dollar, the slingshot. Again, it took a while to. In fact, I posted it on. I have a trading partner. It's in France, and she said, "Oh, it's going too slow." I'm like going, "Yeah, but it's slow, but it's probably going to get to where it's going to go." So in this presentation, I'm going to show you the hidden price floors, ceilings, the pinpoint price and profit, but we're also going to use this on the higher time frame. Okay, so if you look at the example of this picture here, it's a construction of a building. You guys see that? What is evident, or what is a characteristic of a building? Talk to me in the chat box. I will make this kind of a interactive, ceilings and floors, okay? Ceilings and floors. So when you're thinking of price, and if you're thinking of the market, I need you to think of this a building, floors, okay? Okay, now with price, we're not going to use, now if you want to go to the next floor in a building, what do you take? Two ways of moving up and down in a building. How do you move up and down in a building, whether it's a skyscraper or an apartment? Yeah, they're going to use elevator or stairs. Okay, they're nice little pathways up. Whether going up, the staircase. If it's a really tall building, you want to take the elevator. So that's if you want some exercise, you take the stairs, right? But with prices, it's a little bit differently. You have what we call breakouts above floors, above support and resistance, right? And so think of price or market structure as these buildings, but there are no staircases and there are no elevators. The only way you can get to the next floor is to do what? If you had no floor, no ceiling, and no door, how do you get to the next floor? We'll let you use your imagination. A hammer, right? You got a hammer. You got to break out. You got to bust through that ceiling to get to the next floor, right? Similarly, if you wanted to go down, you would have to break through that floor to get to the ceiling, right? Or get to the next floor. Okay. So let's take a look at this. So this is what we're looking at. We're looking at visible support and resistance. Support and resistance is one of the most fundamental part of technical analysis, if that's the only price. I know there's people out there doing quantum analysis and backwards planning and regression, this and that, and all this mathematics, blah 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 blah, and they have huge computer systems everywhere that's cranking out this algorithmic trading, and they make it, and there's calculus and all kinds of stuff going on. I think of Albert Einstein off a chalkboard and all this. All we're doing, people, is finding significant levels of support and resistance, significant floors, significant ceilings. Okay? And at these critical points, we want to be able to buy, sell, or if those places break, if they fail to hold, we want to be buyers above resistance, and we're going to be sellers below support. Okay? This resistance takes place in different ways. We talked about them in previous videos. We talked about resistance being what are some types of resistance? Give me some types of support and resistance. Okay. There's classic, which is price, but give me some others. Type them in the chat box. I want to keep your brain active and keep you engaged and involved. Yeah. Okay, good. This is supply and demand zones. Okay. That's one type of support and resistance. What else? Fib. Vincent, you're on fire, man. It's what time is it? Where you're in California? What time is it in California? Because whatever you're taking, it's coffee time. 3 a.m. Nice, nice. That's dedication. So we have two. We have supply and demand zones, fibs. I said classic. What else? What else is there? Well, there's pivot points, right? There's pivots. There's also moving averages can be used as support and resistance, right? Whole number, round numbers, we talked about that too in the previous video. So all those areas are different types of support and resistance. And they mark turning points in the market. They are the floors and the ceilings. Now, like I said, there's people with advanced degrees in calculus and all this stuff. But if you go back to the origins of trading, if you just know the floor, you just know the ceiling, well then you're basically trading price action, and you know what a floor is. If you go to like an exclusive neighborhood, maybe go Ladera Heights, maybe somewhere in LA somewhere, and okay, the houses are going for maybe 7 or 800,000, right? Maybe $1 million. So if you see a house there in that area, Vince, let me know if I'm right. Am I right? It's been a while since I've been looking for homes in California. I have flipped some. I did some house flipping in California, back in the early 2000s and stuff like that. $1 million easy. Okay, $1 million. Okay, let's say the house is $1 million easy. Okay, and it's beautiful neighborhood. You're about 5-10 minutes from the beach, and so and you're in California, and it's great weather. Okay, now if you saw a house, Vincent, 3-bedroom, 2-bath, $750,000, what are you doing for sale? What are you doing at $750,000? You're buying, all right? You're buying. Why are you buying? Why are you buying, paying $750,000 for a house that's $1 million? Yeah, it's undervalued. Undervalued. Key word. Undervalued is the same as oversold. Okay? It's cheaper than normal. It is an abnormal. It's a steal. Maybe it's distress sale. Maybe the person's going through a divorce. Maybe maybe they're moving, being relocated. Maybe it's somebody died and it's a probate sale and they got split. There's a whole bunch of reasons why. It doesn't know why, but it marks a value. You don't have to be a mathematical genius. Hey, Hemi, how you doing, buddy? Nice. But we're talking about, and I know Australia has some pretty expensive neighborhoods too, and we're talking about property as far as if you see a house that's in $1 million neighborhood. Oh no, we're just getting started. $1 million neighborhood, and we find the house for $750,000 because because it's undervalued. When something's undervalued, it's oversold. So think of forex or trading or anything as a form of supply and demand. In supply and demand, you want to buy what? Buy and sell what? Buy low And yeah, buy high. Yeah, if you're buying a breakout, if you're buying a breakout, Hemi, buying high and selling higher is good. But if you're in a range, you want to buy low and sell high. So $750, if 750 in a $1 million market, it represents what? What type of equity does that represent? I'm talking real estate because I know. Yeah, I knew Hemi's gonna chime on that because I'm speaking. Hemi's a real estate person too. Vince is a real estate. I know Vince has a real estate holding, so I know Adina's done some real estate. So I'm talking real estate here, because that is it's the most easiest thing that people can understand. They understand buy low and sell high. Now, when they get into the forex and they get into trading, then it's completely different. It's like, oh, we're selling, we're selling when it's low and buying when it's high, and that can be disastrous, right? So yeah, 750. I don't need to. If a real estate, I don't need to see the house. I don't need to go to the house, right? Have you heard people say, okay, find me a house in this area? Okay, again, let's say it's again $1 million area. If it's 750 and below, I don't care what it is. Buy it. Okay, because even if it has some foundation issues, even if it's falling down or whatever, the land, the position, the location is so primo that it doesn't matter, right? Right? So if you think of like Aussie, I'm thinking about Aussie dollar right now, and let's say it spiked down to 70, 75 or something like that on a wick. I'm like, that's like oversold. I mean, come on now. We're in an uptrend. 70, if it gets down to 70, I don't have a price in front of me, but if it dropped down, when it's oversold. Okay, but again, going back to our example, 750,000 in a $1 million neighborhood, it represents $250,000 in value. Okay, so think of this. This is the house price right here. Okay, and the top value is $1 million, and you get this spike down to 750. This is what it looks like on a graph, right? Now, maybe, especially if you're looking at California real estate, and in fact, the house I flipped here that I bought for 2.25 and sold it for 3. Well, it's now 5 right now, and I'm like, there we go again, Greg. But but in 2008, I looked like a genius because the market collapsed, right? And that house got back down to back to 2.25 again. Okay. So anyway, I've got this house down here, and guess what? The distance between where it is in oversold or undervalued and the last price that it was, which is $1 million, represents, but the distance between support and resistance is the profit, or $250,000, right? So every time you place a trade, Hemi, Vincent, Adina, Holger, think of it as like buying a small house, okay? And you think about it, if you're trading 100K a lot, you are trading a small house, really, in leverage, right? So you want to find the neighborhood that's the best, right? And you want to be able to take profit. Hey, when this gets back to this old price, it's like, look, you bought it for 750, it's $1 million. What are you doing? Well, I remember the house that we had in California. I said, look, she actually got it for 1.25 before I married her because she's a genius, and it was like 4, and I was looking at charts because this was like 2004, and I applied technical analysis to everything, to traffic, to horse racing, to blackjack, to birth of children. I was applying Elliott Wave to everything that moved, and I applied it to the real estate market. I said, you know what? We need to sell this mug and get out of California. And my wife goes, "No, we're going to keep this in the family, and we're going to do this." And I'm like, "Oh, come on now, we need to get out." But it was, it was hers. I let her do what she wants, and then sure enough, we had the big drop, and so we wind up getting out of it at a lot lower price, right? So the distance, that's what the slingshot is. Think about the slingshot. The slingshot is the $1 million house, right? $1 million neighborhood, right? And it's fallen in price, okay? And you get that generational buy where I don't care if it's on carjacks. There was a house in North Long Beach. I mean, the real estate agent told us, and we were naive. I was like, oh, come on, yeah. I was, teacher. I was, wasn't really savvy about real estate, and and you're kind of suspicious of people. And the guy goes, look, the house you're looking at over here, it was down the street from us, okay? It was $103,000. 103 in California, insane. This is 1999. It was on carjacks. That was the problem. The foundation was on the houses in California are not. They don't have slab foundations. They were on risers. But this one was on carjacks. Like the jacks that you jack your car up. Well, this thing had 8 carjacks underneath the house. That scared the mess out of me. I'm like going, oh my God, this house is on carjacks. It's on carjacks. Can you believe it? And I let the carjacks get in my head instead of looking at the neighborhood. Okay, the neighborhood was 150, and back then it was like, well, 150. I could fix it, and a rental would pay for it. But my brain got so immersed in the problem, and I ignored the opportunity. Well, that house is like $450,000 right now. It may be about $500,000 right now. So I am, so I kind of. I have to have a very short-term memory because you think of all the things that you pass, but there's always another train leaving the station, and we did find a heck of a lot of other deals after that. But it was a lesson learned that when you see a market fall like this, and they say buy when there's blood in the streets. Sometimes when you see the Brexit and things are so bad, and if you looked at divergence, that's where divergence comes in. When all the retail people are selling and institutions switch and get long, that creates that that buying reversal. I know Adina likes looking for that MACD histogram divergence, which shows that, hey, you know what? All this bad news is already priced in the market. The market is a discounting mechanism, okay? The market is a discounting mechanism, so the price is already built in. The fear is already built in. Okay, this thing is still, California real estate is not going anywhere. We're still near the beach, and back in 87, we had that big Northridge earthquake. Okay, the houses went from $300 down to $80,000. Can you believe it? $300 to $80,000. My best friend came up. His mother told me, "Hey, you know what? We can't afford the repairs. We're just going to get out of California. $80,000. How you could have bought houses pennies on the dollar after that earthquake in '87? And guess what? All those houses are over $750,000 right now. Okay, in just a few short years. Okay, in fact, they start turning around like in the first 3 years. So you got to when you see something falling, you got to look at either is it a retracement or a reversal. But if the fundamentals are good, you got to be able to pull the trigger on it. There was a case of Sprint, the stock of Sprint. Something happened, bad earnings or something. This was probably 1998, 1999. Sprint went down to like $2.50. And I saw him at Wall Street, and I remember when Bud Fox said the get-go, hey, the breakup value is higher. You could cease and still make money on it. The current stock value was lower than the breakup value. So I looked at Sprint. They had towers, they had land, they had buildings, they had computers, they had office chairs. All the assets they had was worth more than $2.50. So when that stock dropped to 250, there was a ton of equity in that stock, right? And so I got in the sprint, and I told all my friends, sprint. Within a matter of days, sprint went from 250, 350, a support zone, right? Because it wasn't going any lower. It didn't go to zero. The fundamentals were solid. It wasn't just buy because it was cheap, but buy because it was a good company at a low, very low discount to book, right? And that was support. Through $2.50, $3 of support, and it went up to like 9. So you got a triple on that, right? Bank of America, was Fortress Bank dropped to 2, and I had information that stock was going to drop, so I couldn't trade myself because it was like, it's like on the floor. It's like, oh, why'd you tell me? Because now the SEC would just kill me if I took that trade. So, but I did tell some people, I really like Bank of America at $2.50. It's not going to go anywhere. Well, it's like $14. So that's 7 times. So you got to be able to. The big opportunities are going to happen when we hit these significant levels of support, and those areas of support will happen on a daily basis, and they'll happen even on the minute and the short-term trade. But going back to our topic, or what the thing I want to get to, was that when we get into this kind of a summary doldrums kind of thing, we need to move to where the party is. And right now, the party is on the longer term, and it's a little bit slower, but there's more people there. Right? Because if you are in the Hamptons, you don't really want to watch your trade, so you're probably going to put it in something you can pull long term. And that was my idea behind Aussie CAD and the Aussie dollar was, hey, you've got higher interest rate differential, supposedly, theoretically, but I was paying negative swap on the Aussie CAD trade, and it had a long way to go back to the old high, and was historically cheap. Okay. So let's so again, we talk about support, resistance, and you guys are with me. You guys still with me? Is this good so far? Am I rambling? Light bulbs going on, and is anything going on there? So trading with support and resistance, and it's very simple. When you support and resistance has been firmly established, we buy when price touches, the support line, and you think of a line more of a zone. Notice that it doesn't stop directly on it because you're going to have big orders coming in. It doesn't stop exactly at those points. If it does, it's a gift, right? And you want to look for reversal candlestick patterns, your evening stars at the tops, your inverted hammers, bearish engulfing, inside, outside, inside days candles, dark cloud cover. All those kinds of candlestick patterns for bearishness. You want to look for long wick hammers, morning stars, doji stars, any type of reversal candlestick. Haramis are good too, because if you get a big push down and you see a small candle, you're going to see a reversal. I'm not showing candles here. I'm showing bars. You're like, where are the candles, Greg? Well, not lit. Okay. So we have horizontal support and resistance. There's also sloping support and resistance. We call them trend lines, but trend lines are a special case of support and resistance, right? So prices may be moving down, moving up, but they're testing support and rising and making higher highs and higher lows. All right. So we have resistance, we have support, we're bouncing, and then we come back, and when we break to a lower price, well, guess what? Lower swing low. And price comes up and tests the resistance line, well, then we drop, right? And then the old resistance line or the old support line acts as resistance, right? Old support becomes new resistance, right? And that's typical. That's lore. That's the basis of, because why we have broken below the floor, and now that floor has become a ceiling, right? We break above the floor or above the ceiling, then it's reverse, right? That's the whole idea here. Where this is our building, these are floors. Price does not have an elevator or staircase, so it just makes its way. Boom, more sellers than buyers, right? Long as we have sellers, it's equilibrium. more sellers, more people want to get out of that neighborhood. Okay, all of a sudden they discover there's a garbage dump that's going to be opened up, or maybe a felon or some type of a child criminal offender, sex offender moves into your neighborhood. Well, guess what? Boom. Your prices of your home values go lower. People start selling. Not a good thing, right? Or an earthquake or any type of event can cause real estate to drop, right? So there's anytime you see a break of support, there usually some type of event why people are bailing on this, right? Especially if it's a long-term, long-standing. It could be a cut in interest rates. It could be something major and seismic to make it drop and change direction. Okay. So if price breaks below support level, becomes new resistance. If price breaks above support, then that resistance level becomes the new support level, right? And then you get the staircase kind of thing where we're moving up and then we're breaking. We're moving up and we're breaking. We're running. All right. So we've got that's the basic principle, right? Now, hidden levels of support and resistance. Now, the classic ones are easy to be seen, right? But the hidden levels of support and resistance are your fibs and your pivots. And pivot points are considered commercial support and resistance, as pit traders and large institutional traders use these levels to buy and sell at precise points. Since retail traders had no knowledge of those points, that we consider them hidden. Point calculated using the previous day's high, low, and close. All right, yesterday's high, yesterday's low, and yesterday's close divided by 3. Another name for the pivot point is the typical price. You might even see that on a charting package. You go, I don't see the pivot levels. Typical price, because price exists in 3 states. It has a high, it has a low, and it has a close. So it has 3 different ways it can be expressed during a period. If you take those 3 types of prices and average them out, how do you find the average of 3 different things? You add them up and divide by 3, right? So it's basically the average price. So if you're using daily pivots, it's the average price for the previous day. Or if you're using weekly pivots, it's the average price for the previous week. If you're using monthly pivots, it takes the highest high of that month, the lowest low of that month, and the last price for that month, divide by 3. That's why it's very important. That's why we're coming to month end. Very important, guys. This is the 28th of September. We're recording this. The next month is October. You're like, yeah, no, duh, Greg. It's like, I know, I'm Captain Obvious, right? But then, what does that mean? I'm going to ask you, what does that mean? Talk to me in the chat box. Yeah, markets start to heat up, and Vincent says new pivots. Yes, you're going to have new monthly pivots, new weekly pivots, right? Of course, you're going to have new daily pivots, but you're going to have the highest high and the lowest low and the close of the previous month divided by 3 will give you the average price, right? When you go to a neighborhood and you want to buy a house, the first thing you want to do is get the whats. What we call them in the U.S., Vince? Comps. Yeah, you want to get the comparables, the comps, right? You don't want to go to a $300,000 neighborhood and then some guy's charging $1 million, right? It's like going, well, you know what? Yeah, you're smoking some good dope there, because I ain't paying you $1 million. Your house is only worth $300,000. But I put in marble, and I put in a pool, and I put a second floor in. I go, you have over improved your property, and you have an inflated value in your mind, and there's no way I'm paying you $1 million if every house in your neighborhood for 5 miles is $300,000. It's just not going to work. No bank is going to finance you, and I don't care if you got Italian marble and you've got everything laid in gold. If the neighborhood is $300,000, there's no way you could sell that house for $1 million unless you found an idiot that would do that, right? So that's similar with the next month. You're going to books for the entire market, new ones, new pricing for the entire month, right? For this new month, all right. So the typical price of the Aussie dollar is 77.80. Well, then now it's like you have something to base on. Hey, if we go down to 76, hey, it's a buy. If it goes up to 80, maybe it's too much, right? You're going to get these new ranges reestablished each month. That's another reason why fund managers wait to the end of the month too, other than preserving the gains they have, like Hemi has. But you can, but also you wait till the market establishes its new range. The next month makes the new range. And you also have, that's why in the calendar I tell you, you got non-farm payroll, you got ADP, and that following week, and then you get the new week done, and now you have new weekly pivots, right? But actually, you can use the previous week, this last week. This week will establish the weekly pivots for next week, right? So going to the pivots are divided into, there are different levels. There's R2 and R1 typical pivot, and then there's a central pivot. That central pivot, that line represents the scrum line if you're like a rugby fan, or maybe a line of scrimmage if you're a football fan. Go Cowboys and go Raiders. Where this is like where they start off each day, and a daily is 5 p.m. Weekly starts on Sunday night, and now you're looking at, hey, we're getting above the pivot. We're starting to get into an overbought region, right? R1. Why? Because there were so many standard deviations above what was the average or typical price, right? So the average price of a neighborhood is $300,000, but this house over here is going for, somebody's trying to sell it. I'm trying to sell it. They mean it's sold. They're trying to sell it for $400,000. It's like, well, that's a little outside. Now, somebody buys it for $400,000. That establishes a new range. Now the comps are higher, and now you're like going, okay, that's my wave 3 high, and I'm looking that maybe I can retest that high again if this average price acts as a floor and continues to hold, right? So the average price is $300. If we don't hit $299, $280, 175 or something stupid, then as long as we're staying above this level, we should retest the old high. Okay. It's something it comes into. So even on this little sample slide here, I don't know what it is, but we could probably be confident that after testing the average price, buyers stepped in here, we should see a retest of the old high, right? So because why? Because somebody will look at the comps and say, well, this thing sold for here, and these people got it here. Oh, they're buying it, dips in a rally, and you're like going, hey, maybe this goes a little bit higher, right? Now, if it breaks this, hey, we have a 3, 4, 5. This thing could drop and retest S1, right? And people might say, look, this thing was cheap before. This is too high as it is. We might see sellers drop this back down and retest this, right? So there's a couple of things that can go on here. So if, again, think of this whole market in terms that you understand. Think of it as, it's not a perfect analogy, but I think it's one that actually works. Because think about it. If you're buying a $500,000 house, not everyone has $500,000 laying around. Maybe Adina has some, or maybe I think Dent's probably has something tucked under his mattress. But usually you have to get financing, and you got to get a loan of some kind. And so you put a down payment, and then you get money to control this asset. And when the asset appreciates in price, you sell it and keep the difference. Well, we're doing the same thing in Forex. If we control a $10,000 lot and we're only putting up $100, you're down as 100. You're putting up 10,000. You buy $10,000 of the currency, and it goes up $100, and then you sell it. Well, guess what? You made $100, right? But in this case, you get your down payment back too. The down payment is your margin. So leverage. Now, if you look at some of the laws that have affected real estate in the U.S. and around the world, they're the same laws that affect Forex trading as far as leverage, Dodd-Frank, the whole reduction in loans and stuff like that, and notice how margins have gone up around the world, and the amount of leverage that people were willing to give has gone down, right? Just like lending requirements have tightened up. So they move hand in hand. In fact, they say that the deregulation of the housing market caused the whole global financial crisis. The same bill that deregulated the housing market also deregulated Forex and allowed retail traders to trade Forex. They both came at the same time. So just a little historical note there. And we can thank the Clintons for that. Hey, that was good because we couldn't have access to Forex otherwise here in the U.S. Okay, so here are the hidden levels of support and resistance. I digress. S1 pivot, yesterday's is the pivot point times 2 minus yesterday's high. Okay, and you don't have to memorize this. These are just how these levels are created. Okay, typically price is going to bounce at S1. It represents an oversold extreme. S2, a very oversold extreme. All right, you're very far away from the pivot. S3, we rarely see a test of S. So usually if we're moving through S3, the thing is going down for good, right? And resistance levels is pivot point times 2 minus yesterday's low. Okay, so take the lowest low in price minus the average price times 2 gives you R1, which is a resistance level. Okay, and usually, if we break above R1, we're gonna look at R2, which is the pivot point plus yesterday's high minus yesterday's low, and the extreme value is R3, which is R2, the price at R2 plus yesterday's high minus yesterday's low. So to calculate weekly or monthly numbers, simply replace yesterday's with last week's or last month's or last year's. And I wrote a series of articles on yearly pivots. You're probably not going to find anyone who has wrote on yearly pivots. If you type yearly pivots in Greg McLeod, you'll find about 5 or 6 articles I wrote on yearly pivots and trading pivot points on those longer time frames. Okay, so I'm glad that these calculations are done for us, and we don't. Not in the old days. I remember when Daily FX or FXCM had little dots as pivots, and I was using the platform. I said, look, you need to use lines, guys, as pivots. And finally, they got enough people complaining that they actually put the typical lines that we have now that we take for granted. That, oh yeah, I got pivots. Like, yeah, they weren't that easy. In fact, I remember having a spreadsheet and drawing them by hand on a chart. Okay, not with paper and pencil, but drawing them the horizontal lines using the horizontal line tool and placing them on my charts. Okay, so come a long way. In fact, I have an old pivot point calculator that I used to use. Okay, so here's an example of pivot points, right? So in addition to giving buy and sell signals, pivot points give traders a good time to get out of their trade. To illustrate, during a rally, some traders will set their sell orders right below the next resistance line. Thus, pivot point resistance and support lines can generate ready-made profit targets, right? So you can see how the price came down, held at S2. This could be a weekly S2, okay? Weekly S2. In this type of market, I haven't really seen the daily. I mean, sometimes I just see them hit and miss, but I tell you, those weeklies are I'm sold. I know Adina has been a big advocate of weekly pivots, and so is David Irving, and it's just I had so much on my charts, but now I don't have a lot of time to draw fibs. And if you really take fibs, even if you look at this example, if you took a fib line from this low to this high, that's a 38% retracement right there, just eyeballing that, right? And you can see the S1 is about 50, right? So you can actually see where the pivots and there's a confluence where pivots and Fibonacci actually occur. And since these are automatically drawn, it's one less thing you have to do, okay? So I'm actually drifting back toward pivots. Maybe not so much as the dailies, but I'm probably more convinced about the weekly and monthlies as being something to use. Price came down from here. If this was our wave 3 high, our pullback came at the pivot. We had a spike down to the S1, similar to what pound dollar did today. Got a little spike down like that. And then we looked for a retest of the old high, and we got that. R1 break. People try to sell it. R1, a double top. You can see where this was a double top, came back down. Tweezer bottom, right? Bullish engulfing. Hey, you got a demand zone right there at R1, and we broke to a new high, a close above the previous high, and we have a nice price rally back to R3, right? Now, this on a 5-minute chart, daily pivot's fantastic, but if you are in a market where it's just a lot of chop, right? You want to maybe pull out to look at that weekly and look for turning points on a weekly chart. And those weekly charts, you're going to find, the trades are going to take a little bit longer this was like Aussie dollar. Aussie dollar was a slingshot trade. This looks just like the Aussie dollar trade. Pull back, wick down, and then started moving, and it took several days to get up there, but that's what we did. Okay. And how many people took that Aussie trade? Anybody take that? I know how many of you did the New Zealand dollar as well that showed a similar pattern, but they were all taken off of a daily chart. Now, let's take a look at this. Okay, this is a Euro 15-minute chart, no pivots, and you can see this 2012. Can you imagine the Euro was way up here? Not anymore. We have higher swing highs, higher swing lows. I mean, you can see the divergence pattern right here, right? I don't even have anything on there, but your eyes are so trained that you can probably see here 3, 4, 5, right? Trend line break, and probably there's might have been an S1 right there, right? So why did price turn there? And how can the euro be traded? We see that there's nothing really going on there. There's people that say a price action and this and this and this, but you know what? If we had pivots added here, look at this S1 pivot right there, right? And you can see there's our tag. See, euro finds support S1 pivot, and travels to the midpoint. Right? So you've got, it didn't stop there exactly, right? It came down a little bit. So if you went long, hey, is that the pivot? I'm going to put a buy order in there and 10 pip stop, and you get blown out, right? Chances are, if you did see this and then you actually got a reversal here, I mean, I'm not going to cherry pick this. You got stopped out unless you had a really wide stop. If you had your stop below the M1 pivot, okay. And that's typically when you place your stops, you place your stop below you can use the midpoint pivots to place a stop, or you can place a stop below the last pivot, which is a big one. These M pivots are midpoints, okay? And all they do, the calculation is that they just take the distance between S1 and S2, and they divide it in half, all right? The difference between the distance between S1 and P, M2 divides this range in half. Distance between P and R1 divided in half is M3, and so forth, right? So M stands for midpoint, right? So maybe you place a stop below the midpoint pivot, which is maybe less risk than going all the way in here. Price came down, but if you had a stop just below the swing low, you definitely got stopped out here. Now, let's say you did. It's like, hey, Greg, you know what? I keep my stops tight. I'm below 4 pips below the low, like you said. I got stopped out. Now what? This stuff doesn't work. I lost money, Greg. Come on, dude. I want my money back, dude. No, don't worry, because this was probably a fishing expedition. This is like market maker action right here, right? Prices got pushed one more time, cleared out the stops. Look for price to pop back up above the S1 pivot. You get long on the break back above, and boom, okay. You got a move right back. Now, I made this a long time ago before supply and demand zones, but that would have been the supply zone, a little knot right there. Tag the M2 pivot. And see, actually the supply and demand zones would have marked this out ahead of time. So there you go. You've got this nice push up, and let's look at the next slide there. Again, the S1, very significant. We break S1 and it keeps going. Don't just blindly buy S1 because S1 can hurt, can really hurt you, right? So here we go, S1, buy, right? Price, and then price rejection. We have a Harami pattern. That's a bearish pattern right there. Okay, very important. And so we got midpoint pivot rejection at a knot of, if we were to draw a supply and demand zone there. I don't want to mix metaphors up because your charts can get crazy with zones and fibs and pivots. And I think the cleanest, if we had, so price came there, rejected. Now you're probably looking for a slingshot. You're like, hey, Greg, slingshot trade, breakout north. Okay, cool. Stop below here. Price rallied up, did not fail your swing. We failed to get, and then we're out of this. And then you can say, we failed to make a new high. Okay, we did not get up here. We failed, right? And now we look for, a close below S1, and look, it trended back to the S2, right? Now S2 has a high probability of, this is like Bollinger Bands, and this is like top of the band or bottom of the band. This is oversold, okay? Typical, because this is the typical price, right? This neighborhood is a 13,225 neighborhood, right? So this is $13,000 neighborhood, and now this thing drops down to like 13, 20, And it's like, hey, there's about 75 pips in profit here, right? This represents the distance from P to S2 is your equity, right? That's the value that this is worth because this is undervalued. This is the value here because this is the typical, P is your typical average price. That's the comp, right? And this house dropped and it's below, right? So let's see if we keep going with this example. Okay. Boom. Right? S2 risk is here. Profit is here. Well, look. We exceeded it. And you probably, if it got up here and pulled back down, if you took it here or took 2/3 off here, nice, right? And I consolidated and cracked the high. Well, your third is still running. Your third is making money, right? And I know, Hemi, I think you had a pound trade where you got out, took off your 2/3, and you got that third running, and you can afford to have a wide stop because hey, it's a smaller position, but since this has moved up, you have a higher probability of this moving higher than lower. Why? We're above the central pivot, so we're above the average price, but there's people bidding this up, right? You can see the value that was here that I showed you. Because this was the average price. This was way below. This is that $1 million house. It's $750, baby. All day long. Buy zone, right? I used to have a real estate agent, and I said, look, this is my target area. If you see anything in this price range, put a bid on it. Put a bid on it for me, right? So that's why he said, well, he didn't take a look at it, and maybe he didn't like the bathrooms or he didn't like the sink or whatever. And I was like, no. If it's at that price, location, give it to me. Because chances are there's no equity in this to make up for any repairs that thing may need. Okay. So as we depart, now this was let me go ahead and clear this off. Okay. So here we go. Should we buy or sell dollar CAD? And there's we had a nice downtrend, right? divergence A, B, C. We're at M4. We're past R1. We are the typical prices down here. Now, this is, think of if you are, the U.S. and, it's kind of easy because the global financial market, the whole market got blown up in 2008. But think of this as 2007. Okay. The average price of the house is here. People are bidding up, and they're also like going, their dog. Oh no, my dog wants to live in this neighborhood, and my daughter has to live in this neighborhood, and please, 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 there's this bid being outbid. Is this where you want to buy? Yeah, typically no. Okay, I mean you understand that Lefevre, the author of and this thing in the book, opera of a stock market operator, right? He says that the most expensive parts of the market are the first eighth, and the last eighth of the market is the most expensive part of the market, right? But let's see what happens next, okay? If we have that chart. Okay. Well, there you go. So you had you got a little, I mean, you had a double top at M4, closed back below R1. This confirmed resistance. And if you didn't get in this trade, smart, excellent, good job, guys. You might have had a little scalp there, but man, that was very costly. The amount of risk was huge. Remember, this is the typical price. This is what this thing is worth, and you're willing to pay a premium to get into this thing, right? So you're you're buying, you're buying at $1 million house, $1 million neighborhood for $1.5 million or $2 million. The prices are going up, and I don't want to miss the next move, right? All right, it's going to go up. Oh, it'll come back. Oh, it'll come back. No. Okay. So so we want to be cognizant of what this is, and this is the pivot price is really the average price. Okay. Now, if you get a weekly average from a weekly pivot, that's going to give you, much more data. Monthly is going to give you a lot more data too. But remember, countries, they revalue their economies, they have month-to-month results of like their interest rate announcements and things like that. So sometimes those monthly and weeklies are going to be a lot more potentially helpful. Now, especially if you have a confluence, like if this is a daily pivot and then you have a weekly S1 too, right? And a monthly S1, and now you've got 3 different time frames converging, and price comes back down there. Well, good Lord, you buy that crap, buy two-fisted buy, use your indicators, and I'm not giving you recommendations there, but if you see a confluence of S levels or confluence of R levels, R2 monthly, R1 weekly, R1 daily, that's a sell. Okay, I don't think, short of a central bank jumping in, there's nothing that's going to stop that thing. Or, the Swiss National Bank can blow it out too. Periodically, you'll find confluences of, like if you look at pound yen and look at maybe a couple of days ago, we did touch down like weekly S2, weekly S1, and there was a confluence there. Okay. So And to wrap things up, and to bring put a bow on this, is like hidden support about hidden support and resistance. Support and resistance are basic and vitally important technical analysis tools on every time frame: intraday, daily, weekly, monthly, and yearly. Support and resistance levels are respected by traders. Knowledge of these levels helps keep a trader on the correct side of the market, thus helping the trader get profit. Okay. So again, I want to thank you for joining me for this presentation of finding hidden price floors, price ceilings to pinpoint profit. And hopefully you found this helpful and informative, and that you can apply it in your trading. And stay tuned. We're going to go on break, but then we're going to wrap things up and go to they actually do a we won't necessarily do simulation, because the simulator is not going to have the current one. We are, again, when it's in process, we're working on. We're getting closer to that, releasing that the simulator that has the pivots where you can practice. Okay, but hey guys, thank you for joining me. And Hemi says thank. And what pivots do you really use? I actually like the weeklies. I'm looking at weeklies again. Okay, and so especially during this type of a market. Okay, and especially what you want to do as a strategy. Look at what I did is I made a table. I made a spreadsheet, and what I did was I looked at I looked at Sunday and looked at what was actually opening above the weekly pivot and which ones are operating below the weekly pivot. Okay, using that on a Monday or Sunday, sorry, and you can see that usually, let's see if I could find it. Pivot opening range. Okay, now, I did finish it because I was in the middle of a trade, but the things that opened above the weekly pivot. This is September 26, 2016. Look, dollar CAD, the pivot was 131.62. Pivot was 134. R1, R2, right? And if we were to look at the to bring that up, like I need it. Let's see if I can pull up. So, but you tell me, okay, where is dollar CAD trading now? Okay, so price was 31.62. So it opened up. I looked. This is 96. That was on a that was Monday. Okay. How about euro dollar? Where's euro trading right now? So dollar CAD current price 32.09. I looked at 31.62. That's 47 pips. Okay, so where's euro right now? Yeah, this guy help me out. 32.12. Okay, 112.12. 112.27. Okay, so it's not really doing anything there, right? Okay, and what my goal was to, and you want to do the same thing. I have weekly, above weekly pivot, below weekly pivot, and then at weekly pivot. Things that were at weekly pivot. That's my third column. If I can turn this off, right? So, and the things that were above, like Aussie dollar, Euro CAD, Aussie CAD, I just listed everything that was trading above the weekly pivot and everything that was below the weekly pivot. Now, I know dollar yen, I think, is up. So I'm just kind of experimenting with this, okay? So again, I'm basically coming back, I'm dusting off all my old pivot stuff because I'm seeing, especially for the trading this long term, looking at an hour chart hour chart with weekly pivots. Okay, so you use that hour chart. Okay, let's go ahead and pause here, take a break, and we'll come back in like 10 minutes, and let's go to simulation. Thanks.